If you're looking to buy CASSAVA Sciences stock, then keep watching this video because we're going to look at the company's recent news, how the market's treating it, what are the technicals telling us, and most importantly, what is the best trading approach. As the market remains volatile at the moment, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. CASSAVA has been having a very exciting ride in the market over the past few years, and that kind of very active price action has attracted the attention of retail traders. In its peak, the unit price of CASSAVA, meaning how much it costs per share, reached almost $125, which is very significant compared to where it was just a weeks before reaching the height, as well as comparing to where it went to afterwards, when the stock lost almost 90% of its value. Currently, there are two things that are going on for CASSAVA. The first one is the current price level. Given that the stock has lost about 90% of its value, there is an argument to be made that the share price could get back to where it was, given the right circumstances, either because of company-specific fundamentals or a regain of interest for the sector itself. The second element that could be huge is its ongoing tests for a new product. If this new product gets approved for a phase 3 testing, it could have a huge effect on the share price and to jump up significantly regardless of the final results. This is a high-risk, high-reward scenario, and it would be appropriate for portfolios that are diversified and with significant appetite for short-term risks. Now, let's also take a look at the technicals of the stock. The trading volume of CASSAVA Sciences recently has been around 1.3 million shares versus the average of 2 million shares. Over the previous 52-week period, its price fluctuated between $13.84 and $122.50. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market, and if there's enough liquidity to support a trading strategy. If the float is very thin, it could be easy to influence the stock price, but it could also be very difficult to exit the trade. When we compare the current volume against the average volume, there might be a possibility to spot a trend reversal or a breakthrough if the difference is very significant. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of CASSAVA is currently around $810 million versus the enterprise value of $928 million. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, meaning they're not items or stocks that a company can use right now, but they're pledges for a brighter future, such as intellectual property, goodwill, or schematics. For startups, if most of their valuations are based on those intangibles, they could be valued in more favorable market conditions, and this could mean that a false impression of the market participants is that the company is trading at a discount if its market cap is lower than the EV. But it could also mean that it's been overvalued in the first place and only deflating back to a normal level ever since. As we compare the current price to the historical price fluctuations, the stock is 37.9% higher than the 1-month low, 37.9% higher than the 12-week low, and 37.9% higher than the 52-week low. On the options market, giving us a hint about the market sentiment of where the stock price is likely going to go next, the implied volatility is 137%, compared to a historical volatility of 83%. The put-call volume ratio is currently 0.46. It's normal for most stocks to have a higher put option volume than what they truly deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 2.7 thousand contracts a day versus the 30-day average of 8.7 thousands. In terms of open interest, the most recent volume of open interest is 152,000 contracts versus the 30-day average of 140,000 contracts. The options contracts are tools allowing traders to hedge their risks, increase their exposure, or limit their downside. It's also a potential revenue stream. They are derivative products based on the underlying securities. They give traders the possibility to buy or sell the security at a predetermined strike price, helping limiting the potential downside. The put options allows selling at the strike price, usually chosen for an anticipated downturn, and the call options allow buying at the strike price, usually chosen to anticipate a bullish run. In terms of its shareholder structure, institutional shareholders own about 27.3% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. Usually, it is best to see some institutional participation when holding a stock long-term, because it offers a layer of stability and a token of reliability in the medium to long term. This could also mean that the market is confident that it will deliver value in the long term, which is an important factor to consider. I personally believe that a minimum threshold of around 25 to 30% of institutional ownership should be reached to consider long-term holding. Obviously, there are many exceptions to that rule, and there will always be great companies, mostly owned by retail traders as well. Let's also take a look at the short interest in the stock, which is the number of positions that will profit from falling stock price. The way it works is that short positions will borrow the shares from the broker, sell them in the market, and buy them back later, profiting from the difference between the two timings. If there are significant short interest, usually above 25 or 30%, there could be potentials for a short squeeze, whereby traders will buy the stock up, forcing those with short positions to redeem their positions to avoid further losses, acting as an additional buy for the stock's price action. This is what people refer to as a short squeeze, and it became a popular concept in recent times, with stocks like GameStop and AMC being successfully short squeezed. The current short interest is about 27% of the total float, and 45% of the transactions are coming out of the dark pools. So there is an argument that CASSAVA can go through a short squeeze as well. My recommendation is to buy a small position in CASSAVA now and to wait for results over the next few months. If the testing seems positive, it would be a good time to sell, because that is what most of the value gets priced in. If you're willing to invest in the company for the long term, I would recommend to save a portion of your profit to stay in CASSAVA instead. I would recommend to commit between 3 to 5% of your portfolio in CASSAVA and to limit your allocation in around 20 to 30% at a time to purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.